So we'll begin with this session while others can continue joining in. Once again, this is Deepa Sachanandani, and I welcome you to yet another webinar from Century Financial. So before we begin with this presentation, it's important I get an understanding of the kind of financial expertise you people already have. So accordingly, we can tailor the session depending on your level of expertise in financial markets. So I'll quickly start with a poll wherein the question is, what is your understanding of the financial markets, either beginner, intermediate, or advanced? So if you answer that, I'll get an idea, and accordingly we can tailor the session based on the kind of response we receive. Also, we'll try and make the session a bit more interactive. So if you have any questions, any doubts, please put it up. You can, I will keep asking questions in between. So in case if there is something that you need more clarity on, feel free to approach me and to put up your questions out there. All right, so most of us are at beginner or intermediate level, so we'll try and keep the session a bit light and simple so that all of you can understand the kind of risk and opportunities present in the current market situation. All right. So without wasting more time, let's just quickly get started. So currently, I don't know if you all have been tracking the markets, but there has been a lot of talk going on regarding four major issues in the market. So we'll basically talk about each of these and see how it truly is a major risk for the markets, or we can make a better opportunity out of the same and consider these current situations as an investment opportunity. So, firstly, our prayer and thoughts go out to all the ones who are suffering with the Russia Ukraine situation out there. So, you all are aware about the geopolitical conflicts that are on between Russia and Ukraine. So, we'll be talking about that. Thanks to the conflict, we've seen a lot of commodity prices soar up, and that has already been a problem for inflation. Consumer prices were already high, and because now of soaring commodity prices, inflation is going up further. Then, to tackle inflation, a common tool which most federal governments or central banks take up is that they start increasing the interest rates. And recently, we've seen how hawkish the US Federal Reserve has been. So, that is another concern for markets. And lastly, because of all of these issues, there are people out there who have been fearing recession. We have seen economists talk about recession fears. So we'll tackle each of these points in detail and see whether really it is a point of concern, or have markets already discounted most of these factors and it can be an investment opportunity. So let's start with the Russia-Ukraine crisis. As we've all seen, the Russia invasion of Ukraine actually began on February 24th, and it has triggered many policy actions and moves across the global markets. We've seen massive number of sanctions that have been imposed on Russia. In fact, the Russian ruble reached an all-time low of 121 before recovering most of most of its losses. Oil prices also shot up to the roof, above $130 a barrel. Again, it has corrected now, but at one point in time, oil prices were above $130 a barrel. Likewise, other commodities, be it palladium, aluminium, wheat, iron ore, they've all surged to multi-years high. The reason being, Russia is a major exporter of most of these commodities, and so is Ukraine. Majorly Russia, of course, like you can see, Russia exports 21% of wheat, and Ukraine exports almost 10% of wheat. So obviously, there's a lot of wheat shortage out there, which is why we saw wheat prices shoot up to the roof. Then, even when it comes to metals, Russia accounts for almost 43% of the global production of palladium, 14% of the global production of platinum, and so on and so forth. So, Because of this, we've seen commodity prices go up to the roof, and which has led to further inflation fears. Now, how about the implications of the Russia-Ukraine crisis? So, like I said, obviously, even in terms of oil, Russia accounts for almost 10% of the global oil production and natural gas production as well, which is why we've seen oil prices shoot up to the roof. However, this scenario is not expected to last for long. Of course, we are hoping for markets do not expect this situation to drag on for so long. The war has dragged on for more than expected. But generally, what we've seen in the past that these geopolitical conflicts tend to be short-lived, and markets do tend to recover over the long term. I will be sharing that slide as well with you all. But before that, when we look at the implications of Russia-Ukraine crisis, of course, it is expected to slow down the global growth and raise inflation concerns in the near term. So definitely markets will have some impact because of the same. But when it comes to longer term, and when it comes to US markets in particular, the impact is said to be limited because obviously the US corporates are not really dependent on what is happening in Russia and Ukraine. So their earnings risk for major corporates is really limited because of Russia-Ukraine crisis. We can see a lot of European banks getting impacted because of the Russia-Ukraine crisis, but when it comes to the United States, it won't have a major impact. The Russia-Ukraine crisis will not have that kind of an impact. So, like I was talking and describing earlier, generally geopolitical pullbacks tend to be short-lived, and in fact, historically, in the past, this has been an investment opportunity. So, the chart over here describes how the S&P 500 has performed historically in the past whenever we've seen such kind of geopolitical events. So, on an average, 3 months later, markets tend to gain almost 8%. 6 months later, the average gain has been 10%. And 12 months later, the average gain has been 14% for the S&P 500. Now, S&P 500 is one of the largest indices in the United States, and it's the benchmark US index because it tracks 500 largest companies of the US. So when we look at it from that angle and that perspective, war situations like these turn out to be investment opportunities from a long-term perspective. If you need the money in the short term, then investing right now would not be the best choice. But if you are looking at a long-term perspective, then history suggests that these dips are great buying opportunities. So, like you can see, the max downfall during these sell-offs, I mean, during the geopolitical events, has been 20%. However, the average downfall has been close to 5%, and markets do tend to bottom out on an average in 3 weeks or so. Like it is, the average has been 24 days, so 3.5 weeks, you can see, has been the average uh, duration for the markets to bottom out. And like we've seen, SPX 500 has also rebounded from the lows. Of course, it is still not rebounded to a great extent, but markets have rebounded from the lows. So when it comes to geopolitical pullback, this is not a major risk from an investment perspective in the long term. Of course, when I say these things, it is very important that you consult with your consultants because your risk profile, your investment horizon, everything needs to be taken into consideration before we start investing. So we need to plan out things accordingly. But what history is saying is that geopolitical events tend to be short lived, and we've seen major attacks in the past as well. We've seen North Korea invade South Korea, we've seen the 9/11 attacks, so on and so forth. We've seen the Pearl Harbor attacks, so there have been major geopolitical events in the past as well, and markets have rebounded fairly strongly from those pullbacks. Now, moving on to the next. Okay, also another thing, like I was saying, the Russian ruble actually went up to as high as $121. So basically, it depreciated that much because of the geopolitical crisis. But like you can see, there has already been a strong correction in the USD when compared to the ruble. So ruble has gained strength despite the war still not coming to an end. So markets do tend to react in advance, and we've seen a lot of the negative news already discounted by the markets. So, which is why, from a long term perspective, this turns out to be a good investment opportunity. Now, moving on to our second risk factor that we were speaking about, that is about inflation. And recently, the consumer price index data came in at 8.5%, which is the highest since 1981. So, of course, it is a cause of worry and fear for everyone, because inflation, whenever we see an economy having a lot of inflation, it's difficult to progress and succeed going forward. So that is a major risk for most market participants. Now, let's understand what's causing this kind of inflation. Firstly, of course, there was a lot of money that was pumped into the markets during 2020 and 2021 by governments across the world. In a way to help people and the economy to deal with the COVID crisis. So we saw a lot of money being pumped into the system. So whenever there is a lot of money chasing too few goods, then whenever that happens, we see inflation. There's like more money chasing few goods, and that's what leads to inflation. So that was the major reason why inflation has been scaling high. But beyond that, beyond Russia, beyond the current situation, we also have the Russia Ukraine crisis, which have been responsible for aggravating the inflation. So that has been another key pressing issue for the markets. Also, another factor that has contributed to inflation has been worker shortages in the United States, which has prompted many companies to boost their base to attract candidates, which eventually has forced them to lift the prices for many of their commodities in order to maintain their profit margins. So that has been the reason for inflation. Now, what we are expecting going forward, the stimulus checks that the United States government had passed on to all the individuals back in 2020 and 2021, all of that is going to stop. In fact, it has already stopped. So slowly we'll see. So people have been living on the stimulus checks for the past few months or years. Now, once that stops, of course they'll have to return back to work because they'll have no more money for their day-to-day living. So we see a lot of labor force return back to the markets, and this will help ease inflation. Secondly, when it comes to inflation, the base effect is very important. So when you compare inflation to the prices of 2020 or 2021, obviously it has shot up to the roof. But gradually, when you compare the inflation in 2023 to the base prices of 2022, which are already very high, then inflation will automatically start correcting. So that is one reason why inflation is not expected to be a major cause of concern going forward. In fact, if we look at the core prices, the core price data, which excludes energy and food, inflation for on a month-on-month basis, CPI data rose only 0.3%, which was the slowest increase in the last 6 months. And this could be a sign that the inflation has already started peaking out. Both Wells Fargo and Barclays also reckon with the fact that inflation has likely peaked in the month of March. And in fact, Barclays is expecting yearly inflation will settle around 6.4% in June and 4.4% at the end of the year. So from 8.5%, we are expecting it to come down to 4.4% at the end of the year. So obviously, when it comes to inflation, we can see that there are signs that inflation might be peaking out. Now, another why do markets generally fear inflation? There's a common perception that obviously when there's a lot of inflation, you do not end up making good returns when it comes to equity markets. But again, let us try and look at the data and see what the data has to say. So, if you look at this information, the data does suggest that higher than usual inflation doesn't have a material impact on equity returns. The median inflation adjusted returns of US stocks over the 2 years following periods of high inflation was nearly identical to the 2 year return of periods after lower inflation. So when we had high inflation, the returns next 2 years was 18.5%. And when we had low inflation, the returns for the stock markets the next 2 years was 18.7%. So if you see, there's hardly any difference. So it's just more of a fear than it's a perception that high inflation will not lead to good returns in the US stock markets. In fact, if there is one way you can beat inflation, it should be through investing in the stock markets, because that will allow you and enable you to beat inflation. Now, let's understand what has been the kind of inflation since 1926 till the end of 2020. So, for us to be able to sustain inflation, we would require our funds to grow by at least 15 times to sustain inflation. So $100 is now equivalent to $1,500. So the value of $1,500 back then in 1926 was just $100, to put it the other way around. So to fight inflation, one would require $100 to grow up to $1,500. Now, let's understand, if you would have invested the same amount in US stock markets, what would have the situation been? So $100 in the US stock markets, and I'm comparing this to the S&P 500, would have grown by 455 times. So just a mere $100 would now be worth $45,500. And I mean, this is just at the end of 2020. Markets have grown even higher after that. And secondly, when this data is more on a conservative basis, because the dividends data that was available only from the year 1982 on Bloomberg. So it doesn't consider the dividends that were received prior to the year 1982. So it's on a more conservative basis. If you were investing in markets, and a mere $100 investment by our ancestors we would now have $45,000 available in our accounts. So that's the kind of returns that equity markets have provided. And that is the reason why we need to invest in equity markets to help us fight inflation. Now, moving on to our next risk, our next major risk that markets fear right now is where the U.S. Federal Reserve has turned aggressive and is talking about, increasing the interest rates, and they will even go on to doing balance sheet reduction. So, firstly, why are interest rates negative? Increase in interest rates bad for markets? Obviously, when we see a rate hike happening, so what happens is that if a company needs to borrow money, for example, they'll have to borrow it at a higher cost. When they borrow it at a higher cost, their profitability levels will dip. And when profitability levels will dip, obviously the equity market returns will also be lower. So generally, interest rates, there are other factors also which contribute. This is just trying to explain it in a layman language. But increasing interest rates are generally considered negative for markets. So the Federal Reserve has gone ahead. In fact, they've already increased the first rate hike since December 2018, and we did see a 25 basis rate hike in the last meeting. And now they've even come across and said that they will, the kind of money that they had pumped into the system, they'll start withdrawing, pulling that back, and we'll see a balance sheet reduction of 60 billion in treasuries and 35 billion in mortgage-backed securities. Basically, the U.S. Federal Reserve will now sell 60 billion treasuries and pull that excess liquidity out from the markets. So that is what we are expecting. That is what they've stated in their recent minutes, and markets have already priced in almost 8 to 9 rate hikes. So, what has happened is that, according to one of the most widely watched tools, the CME Fed Watch tool, that is suggesting that there is an 85% probability of a target rate of 2.5 to 2.75% by the end of 2022. And right now we are at 25 to 50 basis points. So we are expecting, already markets have priced in almost 8 to 9 rate hikes. So most of the negative news, according to this, seems to be already priced in. If I show you the treasury yield charts, so the treasury yield out here, the 10-year yield is already above 2.8%, and the 2-year United States yield is already at above 2.4%. So interest rates have not even gone up to that extent, but the 2-year yields have already gone up to 2.4%, whereas the actual Fed funds rate is only at 0.25%. So what this says is that most of the negative news, markets have already priced in so many rate hikes. So this can in turn be an investment opportunity, because almost all the negative news seems to be priced in. Now, moving on to our next aspect when it comes to yield curve inversion. So, right, like just what we saw over here, yields are basically nothing but interest rates. So, we have our 2-year yields and our 10-year yields. So, what you receive for 2 years, when you deposit your money, that would be your 2-year yield, as well as the 10-year treasury yield is basically showing what is the current interest rate in the US in for a 10-year horizon. Not exactly the interest rate, but almost a similar benchmark. So this is the 2-year and the 10-year treasury yield. Okay, the yields that you receive on government bonds, the interest rates that you receive on government bonds. So now, what had happened was, generally in a normal situation and in a normal scenario, when you invest in a long term, from a long term perspective, you would expect to receive more returns in the longer term than you would expect to receive if you are investing for a shorter duration, say for only 2 years. The reason being, obviously, when you are investing in the long run, for a longer perspective, for a longer time frame, you are taking more risk. There's more risk of inflation developing over the periods. So obviously, one would expect more returns in the long term when compared to investing in the short term. But what had happened briefly recently in the past, we had seen 2-year returns, the 2-year yields had shot up more than the 10-year treasury yield. So that created a panic situation, because whenever that has happened in the past, we have seen a recession occur in the next 12 months, and this has happened almost every other time barring once. So this has been, a cause of concern for many market participants. The 10-year and the 2-year treasury yield dipped to almost minus 0.08 percentage points at the end of March. So if I were to show you the chart, this is what happened at the end of March. But like you can see, it dipped below zero, but it was only for a very short span of time, and it quickly recovered, and it's now at 0.36%, or it can be said as 36 basis points. So that situation was for only a brief time and not a major issue for the markets, because generally a recession happens only when the yield curve stays inverted at least for more than 1 week, which did not happen. Now, secondly, what we've seen in the past, whenever the yield curve inverts, for the next 12 months, S&P on an average has gained 7.4%. Again, a good investment opportunity. Third point that we can consider over here is that uh, rather than the 2 year, 10-year yield, an important factor that needs to be considered is the 3 month and the 10-year yield. If that inverts, if 3 months tend to offer more returns than the 10-year yield, then it is a cause of concern. But that has not happened. In fact, they are almost above 2%. So that issue is not there right now for the markets. So we obviously, in terms, if you were to consider all of these perspectives, it doesn't appear that you really need to fear about recession. In fact, maybe the sell-off might be overdone, and this can be a decent investment opportunity. Now, before we move on to the next slide, I'll again like to ask and start a poll. 1 minute. All right. So the question is very simple and straightforward. How many of you foresee a recession coming in the next 12 months? Like, do you foresee a recession coming in the next 12 months? All right. So 57% of the people feel that we will not see a recession, and 43% feel that we will see a recession in the next 12 months. All right. So almost divided, but yes, let me share an interesting stat with you, wherein the New York Fed probability of recession in the next 12 months is at a mere 5%. So I think most of you all got it right. We are not, according to even most of the economics and the widely tracked parameter of the New York Fed probability of recession, we are not seeing a recession coming in the next 12 months. And for those who are not aware, a recession, the definition of recession is basically if we have two consecutive quarters of negative GDP. So if we see our GDP fall for two consecutive quarters, that's when you call it as a recession. So in fact, according to most predictions, the US economy is predicted to grow by almost 3% or more this year. So definitely, from the looks of it, a recession can be ruled out in the coming 12 months. Again, nobody can guarantee or predict anything, but the current situation uh, is ruling out an inflation. Of course, if war prolongs or if inflation shoots up to the roof and we cannot curtail it, then we could see some issues. But given the kind of Fed rate hikes that are already planned in fact, markets have already discounted a 50 basis point rate hike at the next meeting. So, keeping all of those things in mind and the signs of core CPI prices increasing at the slowest pace in the last from when compared to the last 6 months, overall signs are pointing out to no recession in the coming months. Now, another trend that is actually favoring an opportunity right now in terms of seasonality, if you see the month of April has been really bullish for the S&P 500. Uh, Mostly, like barring 1 year, in the last 15 years, we've seen the S&P 500 gain on an average 3.24% in the month of April. Now, there are various factors that contribute to the same. We also have the tax filing and the mutual funds rearranging their portfolios. So we have many reasons responsible for the same. But this month, in fact, S&P 500 is almost down by 2.5 to 3%. So when it comes to the seasonality analysis, this could actually be a decent short-term investment opportunity if it turns out in our favor, and if SPX actually rallies in the month of April that it has done previously. So this could be a good statistical fact that is favoring the bulls. Now, moving on to the next one, there's another interesting statistical fact which says that S&P 500 did enter a correction for a brief period this time at the start of the year. When we say a correction, it means when the index is down by more than 10% from its high. So S&P 500 did enter into a correction phase on 22nd February. Now, whenever that happens in the past, we've analyzed how do markets react in the future. So on an average, the index is up by almost 25% the year later, and the probability of that happening is almost 90%. So and in the next 2 years, the average gains for the S&P 500 is 37%, and the probability is 87%. Fairly strong probabilities, and probably an interesting statistical fact uh, which would prompt many bulls to start making use of the opportunity and start investing in the markets. So these are some of the key statistical facts that we saw and the key issues that the markets are facing currently. Now, what we'll be talking about in the latter half of the presentation is that how can we invest in the global markets during these crises, and what are the different tools that we can use to invest and participate in the markets in such a situation. Now, before we go forward, I don't know if how many of you all have heard of the term SIP, that's like a systematic investment planning, which talks about investing a fixed amount of sum every month in order to participate in the markets. So you do not try and time the markets, and in fact, you invest a fixed allocation as decided right at the start, and you invest a fixed proportion every month. That is what is called as an SIP based investment, that is a systematic investment planning. So now, before I share the data with you, I would again like to raise a poll and ask you. For example, if we invested $1,000 every month in the S&P 500 since the year 1988, what would have the returns been? What would have the value grown up to as of today's date? So there are options out here, and you can accordingly select the option that you feel is correct. I'll just start the poll. $1,000 SIP in the S&P 500 since the year 1988 would have grown to what amount? Either 500,000, would it be 1.5 million, would it be 2 million, or would it be 3.5 million? Okay, so far our polls are pretty much divided. There are some who feel it would be 500K, some who feel it would be 1.5 million, some who feel 2 million, and some who even think it would be 3.5 million. All right. Yes, we have the maximum votes for $2 million. Well, don't you think that's a significant amount of growth? But for those of you who thought it was 2 million or less than that, well, you all were wrong, because in fact, the amount is close to almost 3.5 million, 3.6 million. So just a systematic investment of $100,000 every month um, would have given you almost 3.6 million as of today's date. If we started the same since 1992, that would have grown up to 2.25 million. If we started this since 2002, that is a period of 10 years, an investment of your total investment would have been 243,000, whereas the value would have grown up to 932,000 as of today's date. So That's like almost four times your returns would be almost four times. And if you invested back in 2012, sorry, so 2002 is of course a period of 20 years, and in the last 10 years, your a fixed investment of $1,000 would have grown your wealth. It would have more than doubled it. 123,000 would have grown to 279,000. So that's the benefit of compounding and of a systematic investment planning, wherein you park your money without considering about if this is the right time to invest, or if you should wait for a further dip. It's a systematic investment planning. What happens is that when you invest regularly, you automatically tend to capture the dips in the markets, as well as you do not tend to miss out any opportunities. So we know of many clients who were waiting for a further dip back in 2020, but there was no such dip. Markets kept rallying, and making new highs. So there were many clients who missed out on this opportunity. So if you were investing regularly, you wouldn't have missed out on this opportunity. So in the current markets, a decent way to participate in the current markets, wherein there are a lot of fears out there. Of course, some of them seem to be overdone, but when there are a few situations which could go out of hand, an SIP would be a decent opportunity, a decent way to capture the opportunity in the index. Now, second thing and most important thing that one should keep in mind is avoid using excess leverage in volatile markets. So, the beauty of leverage, when I say leverage actually means you're borrowing funds and investing in the markets. So, if your account is say for $100,000, you can trade worth even 1 million in $100,000 account. So basically, when you trade worth 1 million in $100,000 account, that is actually said that you're taking 10 times leverage. So what will happen is that when you take 10 times leverage, so your profits will multiply by 10 times. So if your stock has gained say by 10%, because you've taken 10 times leverage, your on 100,000, 10% would have been just merely $10,000. But on 1 million, $10,000, 10% would be almost $100,000. So your 100,000 would have doubled to 200,000 because you took a leverage of 10 times. But if you look at it in another way, in case if there's a loss of 10%, that 10% would mean you would lose out $100,000, which is your account getting liquidated. So that is why it is important to avoid using leverage during such volatile times. You stick to very minimal or low leverage in these markets. And for investors who do not like taking risk as a risk, it's important that you do not take any kind of leverage. So of course your profile needs to be considered, and your investment horizon, everything needs to be taken into account, and you can discuss your planning with your financial consultants and then decide. But if you are a risk averse investor, then it is obviously advisable not to take leverage, especially in markets when there is no clarity and when there is a lot of volatility out there. So during such times, taking leverage is not recommended. Now, moving on, another way that you can participate in the markets is through one of our key highlights and our key portfolios, that is a ladder portfolio. Now, as the name suggests, it's obviously a ladder strategy wherein we will not be investing everything upfront at one go, and we will be investing in phases. Allow me to just share my screen because I don't feel this is very clear. So, just a minute. Right. So this is our ladder portfolio. Now, as you can see over here, given the kind of situation that we are dealing in, when there are rate hikes planned, when there is a Russia-Ukraine crisis on, when inflation is also high. So we start investing in phases wherein this will allow us to capture the dips in the markets and to not invest everything upfront straight away. So what we'll be doing is that we'll be investing 20% in phase one, another 35% when there's a correction or a dip in the markets by 5%, and another 45% when there's a further dip of 10% in the markets or in the respective stocks on an average. So this is how we will be investing. Now, when there's a detailed explanation about each of the stocks that have been included in the portfolio, I can always ask the RM to share the same with you all, and you can go through it. But if I were to explain the strategy in this case, we'll be investing, like I said, um, if it's a 1 million portfolio, we'll be investing 200,000 in phase one, 350,000 in phase two, and 450,000 in phase three. Now, when it comes to phase one, we will be divide. I mean, when it comes to all the phases, in fact, we will be dividing our investments between aggressive stocks, moderate stocks, and conservative stocks. Firstly, if you can see, in fact, all the stocks that we've included in the portfolio are all quality names, big companies out there, which have a better ability to, face any downturn in the markets, if any. So, which is why we've selected strong names and good companies, and we've divided the portfolio in a way that we have both, reopening stocks as well as some technology names in our portfolio as well, because many technology stocks have already given a decent correction from their highs. So we can start investing in phases. Now, like you can see, out of this 200,000 in phase one, 60,000 will go into aggressive companies. When I say aggressive, we talk about mostly technology companies or stocks that will, move more on an average when compared to the S&P 500. Then we have moderate stocks such as Starbucks, Walt Disney, which tend to move in line with the S&P 500. And lastly, we have the conservative stocks. These are stocks that tend to do well whenever there's a slowdown or a recession in the markets. So, currently, because there is a lot of fear going on in the markets, we've allocated a maximum proportion to conservative stocks because they will help you ride out any kind of volatility in the stock markets. So our maximum allocation will be towards conservative stocks. Slowly and gradually, as and when markets start correcting, and once most of the correction has already happened, that time our investment will be the least in conservative stocks and most in aggressive stocks. So this is how we will be phasing out our investments. In total, we'll have 40% or more in aggressive, 39% in moderate, and almost 20% in conservative. So this is how we will be planning out our ladder portfolio, and our investments will be in phases. This will allow us to, not invest all our funds upfront straight away, and if there are any dips in the markets, we can capitalize on the same. So you can go through this portfolio in detail. It also consists of some indices which are a part of the moderate category, and you can read about each of these stocks in detail. I can ask the RM to share the same with you going forward. Now, moving on, just like we have our ladder portfolio, we also have an index ladder portfolio. So if there is someone who's not comfortable with individual stock companies, you can directly invest in, a an index of a particular nation. So when you, for example, for the United States, you have the S&P 500, which tracks the largest 500 companies in the United States. Then we have Nasdaq 100, which majorly tracks technology companies. And then we have Russell 2000, which is tracking 2000 small companies in the United States. So it's basically tracking 2000 companies of the Russell 3000 index, the largest 2000 companies of the Russell 3000 index. So, like you can see in this case, 50% or more of our investment will be to United States. Our major exposure will be to the US, and then we'll have some exposure to the European indices such as the France 40 and Netherlands index. We've tried and shortlisted indices on the basis that they would have a minimal impact from the Russia-Ukraine crisis, and hence we've considered these indices. And then you have the UK 100 index and the Canada 60 index. Now, Canada 60 index has many oil companies as well from the energy sector, and because the energy prices have been shooting up to the roof, obviously Canada 60 will also benefit from the same, which is why so we've considered a mix of all the indices. And like I said in the start of the presentation, I don't know if you remember, but if United States is said to have the least impact of the Russia-Ukraine crisis, which is why we've allocated the maximum proportion to the US. And investments will be done again in phases, wherein 200,000 will be in the first phase, 350,000 will be in the second phase, and 450,000 will be in the last phase. So again, this is it's a percentage basis depending on how much ever you want to invest. If it's all 500,000, we can accordingly tailor our portfolio based on your requirements. So this is how your investments would look like: 50% in US, 24% in the Eurozone, UK will have 12%, and 14% would be to Canada. So this is another strategy that can be considered in the current markets. Now, other strategies that you can look at are, we call them as market neutral strategies. So these are strategies wherein you're not betting on the direction of the markets, that if the market will go up or down. You're trying to capitalize on just the difference or the spread between two commodities or to indices, and or so on and so forth. So let me just try and give you an example. So very recently we had rolled out a strategy based on Brent WTI. So as you are, or most of you all might be aware, Brent and WTI are basically two forms of oil. One is the light quality oil and one is the heavy quality oil. So generally, on an average, Brent and WTI, we've seen they trade at a spread. When I say spread, that means the difference between Brent and WTI has been $5 to $6 or $7 to $8 historically in the past. Now, what happened in 2020 and 2021? The spread between Brent and WTI dipped below their historical average, and it fell to almost $1 to $2. So that was a good investment opportunity because the spread had dropped between the two to $1, and we were expecting Brent to again trade at a premium to WTI, because generally, historically, Brent always has traded, and not always, but in the last 15-20 years that we've seen, Brent has traded at a premium to WTI crude oil. So in a current situation when the spread had dropped to almost $1, it made sense to buy Brent and sell WTI, wherein you were expecting the spread to widen and come back up to to the historical levels. So if you can look, this was the trade that we had given on 16th of Feb 2022, wherein the spread between Brent and WTI was just at $1, and we were expecting Brent will outperform WTI, and that is exactly what happened. When Brent prices rose much more than WTI, and so you ended up making profits. So for those who did not understand this strategy, you all can, if you want me to explain it further in detail, you can tell it to me, and I can, again explain it once more, because it could get a little tricky. So if you've understood and if it's clear, you can just give me a thumbs up and I can move ahead. If not, I can, explain it once more. So the whole point and the whole logic behind the trade is that generally Brent trades at a premium over WTI. And if that is not the case, so for example, if Brent starts trading at a discount to WTI, then obviously other nations who are using Brent will start, who are using WTI will shift to Brent and start using Brent, and overall Brent will again start trading at a premium to WTI. So we are basically just trying to play on the spread between the two commodities. The average is close to 6 or 7. When it dips down to 2, you buy, and you buy the ratio, basically you buy the spread, and when it is above at 11 or so, you sell the spread. So right now Brent was, trading only at a premium of $1 compared to WTI, and historically we've seen it trades at a premium of $6 to $7. So we bought Brent and sold WTI, and in turn made a profit of, almost 3.5% in less than 2 months, which is equivalent to an annualized profit of more than 20%. In fact, the spread even went up to as more than $6, as you can see in the chart out here, before it's currently dipped back to 4.75. So that would have implied a profit of almost 6% in less than 2 months. So that's like more than 40% on an annualized basis. So, in a current situation when there is no clarity about the direction of the markets, such market neutral strategies help you, ride out the current volatility in the markets. So this can be a great way to participate in the markets. We also recently had, spread spot future spread opportunities when it comes to gold and silver. So this is basically a kind of trade wherein, I mean, it could get a little more complex if I were to explain it out here, but this is more of a calendar spread wherein, the future prices of a commodity is trading at a premium when compared to the current price. So if you can see, the gold spot contract was trading at 2062, whereas the April contract was trading at 2068. So when the futures, I can explain more about this in another session, and we can keep it restricted to just understanding what are futures, what are spot contracts. But basically, again, it was kind of an opportunity in the markets wherein you were expecting, you're not betting on the direction of the market, you're just buying one and selling the other one. So as such, you do not have a major risk in the trade that you take, and you just try and capitalize on the mispricing between the two contracts and gain some funds out there. So again, on an annualized basis, the trade almost resulted in, 14% profit in a span of hardly any days. So that's how these spot future trades are, and as and when they are available, we can take them. They are not available throughout, they are available on, whenever there's an opportunity. Because of the Russia-Ukraine crisis, futures contracts shot up to the roof, and so we had an opportunity out there, and we took the trade. So many of our clients took this trade and profited on the same. So again, all of these things you have to discuss with your consultants if it is apt for you, and only then take the trades. So this was the other strategy. Now, overall, when it comes to your portfolio, how can we devise a portfolio and invest in the current market prices? So yes, one way, like I said, we can almost 50% can go towards a ladder portfolio and to an SIP form of investments. So that has to be your key way of investing in the current markets. Remaining 15%, we can look out for market neutral strategies like I just described, wherein you're not betting on the market direction, you're just buying one and selling one. So as such, your risk is very minimal. Now, because growth stocks have dipped drastically, many growth stocks have corrected because markets have almost discounted majority of the rate hikes. So most growth stocks have in fact dipped by more than 50%. So investors who are willing to take some risk can consider adding growth stocks also to their portfolio, a small proportion, 10% or so. Then we have some safe haven assets, such as gold, or the dollar is considered as a safe haven asset. So whenever you see crises like these, especially a war-like situation, generally gold prices rally. And like we've seen in the recent past, gold prices have gone up. In fact, they're almost nearing $2,000. So some proportion can be allocated to safe haven assets like gold, and even dollar, which is now the dollar index is now above $100 mark. And last but not the least, we can look out for some seasonality trades. When I said seasonality trades, they are more specific to commodities in general, because commodities generally have a seasonal nature attached to them in terms of their demand as well as supply, because of the weather and the climatic conditions and so on and so forth. So, very recently, we had, just to share some of the seasonality traits that we had presented recently. Um, just a second, I'll share my screen. Right. So, if you can see, this is the natural gas seasonality that we had rolled out for the month of April, wherein on an average, natural gas prices tend to rally by 7%. Again, I can ask the marketing consultants to share the flyer with you, or your respective RMs can share the flyer with you. Now, like you can see, we had rolled out this flyer where natural gas will rally, has rallied historically in the month of April, with only 1 year seeing negative returns. Now, we are already halfway through April, and if natural gas prices are in fact up by almost they are up by, sorry, yes, they are up by almost 20 to 30%. If I were to share that as well with you, 1 second. So if you can see right here, natural gas prices in the month of April are up by 32%, and this is after they've gained 28% in the month of March. Of course, one of the major factors contributing to the gains was the Russia-Ukraine crisis. But apart from that, it is the seasonality that plays out. So for commodities, generally we see a lot of seasonality trades that happen on an average. If in fact, even if you can see in the month of August, we had even rolled out the seasonality in the month of August for natural gas. On an average, August has also been a positive month for natural gas, and it did gain 11% last August as well. So, seasonality trades do a small proportion of your portfolio can be, put in for these seasonal trades, which are available on an app, on and off almost every month. So we can take these trades. Another seasonality trade that we had shared with our clients was about gasoline seasonality for the month of March and April, and gasoline offered stunning results. If I were to share that as well with you. Um, just a second. So here you can see it. We had shared the positive seasonality for gasoline for the month of March as well as April. For the month of March, gasoline gained almost 14%, and for the month of April so far, gasoline has gained already almost 5%. So, seasonality trades do tend to work out, not necessarily always they will work out in your favor, but on an average, the month of March, especially for gasoline, has always been positive. Of course, 2020 was an exceptional year because this was when we saw massive, I mean, almost the entire world had shut down and there was a lockdown almost everywhere. So that is what contributed to major losses for gasoline. But on an average, if you see, it's been a brilliant opportunity to invest in gasoline in the month of March and April. So these are some of the opportunities that we do come across with on an on and off basis, especially for commodities. Almost on a monthly basis, we do see many opportunities out there, and accordingly, like I said, we can cater a portfolio wherein we have a balanced approach when it comes to our investments. So yes, that's it from our end for today. If you have any questions or any doubts, feel free to ask, or else we can wrap up this session. All right. So we have questions from our guests, who are asking about what about the interest rates? Will it also increase? Yes, interest rates are expected to go up. Like we've seen, Treasury yields have already gone up. So as and when the U.S. Federal Reserve will increase the interest rates, we will see. I mean, will increase their we as and when the US Federal Reserve will go for rate hikes, we will see interest rates also go up. So I hope that answers your question. Interest rates will go up. Then we have a question about what is the minimum investment required. Well, now on an average, the minimum investment that we consider is close to $10,000, because that will allow you to create a diversified portfolio like we described in the current situation. But you can, get in touch with your RM to discuss this further. But I would recommend at least $10,000 in order to get a diversified portfolio. Now we also have another question: how long will oil rally at $100 levels? It's a good question. There are predictions by J.P. Morgan and many other banks that this year, on an average, oil will end up at $110 a barrel. And with the fact that the world is reopening and oil demand is high, so we do see oil prices remaining elevated above $100 a barrel for the foreseeable future at least. Um, the only positive for oil price for now, which can have an impact and lead to some pullback in oil prices, would be the COVID lockdown in China. So Shanghai recently went into a lockdown. So and with that happening, of course, the demand for oil can be lower. But apart from that, all other factors, given the Russia-Ukraine crisis and with the world reopening up, the demand for oil is expected to remain elevated, and that could most likely put a pressure on oil prices. So it might remain close to $100 a barrel or more. So, do we have any other questions? So I think we do not have any further questions, so we can wrap up the session out here. I hope you had a great understanding of the financial markets. In case if you have any further questions, you can always reach out to us personally. We can do a one-on-one session as well, and we can take it forward from there. Also, if you could rate us on Google as well about our webinars, and provide us a rating as you feel appropriate. This is Deepa Sachanandani once again. Thank you so much for attending the session, and hopefully we connect once again in the future. Thank you very much.